Hey everybody, in a previous video that I made about a month or two ago, I talked about how the gross output of the economy was actually showing a contraction in quarter 2 economic growth because gross output measures not just the consumer side of the economy, which is what GDP numbers mostly measure, but it also measures the producer side of the economy as well. Putting the two halves together gives you the whole look at the entire economy. And then I pointed out that when you control for producer prices for the sales of producer goods, as well as the investment of producer goods, and then you control for consumer prices with the sales of consumer goods, adding those together, that's how you get what is called the real gross output, and how that number would likely point to a contraction of the real economy in quarter 2. Now, of course, the GDP numbers are not showing that. Real GDP is actually showing numbers very positively right now. So let's take a look at the year-over-year real GDP numbers right now, okay? So the real GDP numbers are showing a year-over-year growth rate of over 12%. Meanwhile, the producer side of the economy is only growing year-over-year at a mere 2.4%. And then annualized, the real gross output is at 5.4%. Now, I just got done telling you that I made a video that says that, wait a second, real gross output actually contracted. Why am I showing a positive year-over-year number? And the answer is because the contraction has not set in yet from where the economy bottomed out in the middle of quarter 2 2020. So the gross output numbers just came out and validated what I was projecting in a previous video. And now it has confirmed that yes, we are undergoing an economic contraction going on, likely speaking with inflation picking up in the fourth quarter and remaining high, especially on the producer levels. It is telling you that there are less producer goods being sold. And even though there are still more consumer goods being sold thanks to the stimulus bills and generous monetary printing, the higher prices on the producer side is going to feed into less consumer goods being sold soon. Now, when is that going to happen? That's what I'm going to cover in this video. So before I go any further, if you like the content that I produce, make sure you click the like button on this video. Subscribe to my channel if you haven't already. Hit that notification bell, click on that, and then also drop me a comment. Let me know what you think about all the information that I'm feeding to you. So when we take a look at the month-over-month changes of gross output and real GDP, this becomes more pronounced. So when we take a look at the quarterly change, the change from one quarter to the next, we can see how real GDP is sort of flatlined after bouncing back in the third quarter of 2020. It's still showing a pretty sizable real GDP growth, and on the surface, things are looking okay for the economy, but beneath the surface, high producer prices are eating and eroding into the producer side of the economy, which in my opinion is the more important side of the economy than consumer side, because if you don't produce goods, then you have no goods to consume with. So eventually, when these producer goods become depleted enough, it will start to escalate the consumer prices on the consumer side because of shortages developing in certain needed goods, and it will result in a recession. Already on the producer side, there's probably going to be a contraction in the coming months in the employment for the goods producing sectors of our economy. When we take a look at goods producing employees, we already can take note here that the amount of people employed has not recovered back to where it was before COVID. So it's about 1 million people short of where it was pre-COVID when you extrapolate the growth rate of employees in the goods producing sector. And you can already tell that before COVID, we were already beginning to see a flattening in employment in the goods producing sector. When we take a look at the producer output here, we can already see that the quarterly changes of producer output were already flatlining, meaning that we weren't really producing anymore on the producer side. It was all on the real GDP side, and that could be pointing to a soon recession, even if we didn't get that recession from the COVID pandemic. In other words, if we never had the COVID pandemic, a weakening of the economy, especially if producer prices were to escalate there, would have already eroded economic growth absent of some type of stimulus to keep real GDP numbers afloat. So that's what's going on right now. When we take a look at previous crashes, and we're only going to be able to take a look at two trends of what's going on, we can kind of extrapolate how much the contraction in the producer side of the economy will have on the consumer side of the economy, and then figure out when give or take a quarter or two, we should expect the economy to actually contract on the real GDP numbers. But these real GDP numbers is just really a confirmation of the contraction. The contraction is already happening now. This has been the first quarter, second quarter GDP, and I mean gross output, that we're seeing the contraction when you control for producer and consumer prices. Now, when we look back, we can see when the producer side started to erode and it started to contract sharply, meaning that the growth rate contracted by 2% or more, that would then lead the economy into recession. For a frame of reference here, we did get a contraction in producer output here of almost 2% in 2011 for 2 quarters, and it did weaken GDP growth after GDP growth was already anemic, but it didn't really drag the economy down into recession. Of course, keep in mind, that was with fiscal and monetary stimulus juicing the economy, trying to keep it afloat, versus 2008, when the Fed was actually engaging in relatively contractionary monetary policy that crashed the markets. Nevertheless, that's what's going on now. We have high amounts of fiscal government spending, high amounts of monetary stimulus that would make Ben Bernanke and Barack Obama blush with envy. And right now we're reaping the consequences of that in high prices on the producer front, as well as high prices on the consumer front. They're just not at the levels as they are on the producer side of the economy. So when we take a look and try to project out, this is what we're seeing on the real gross output change year over year. We can already see that gross output did spike year over year growth rates for 2021 quarter 2 because the growth rate was so low, so negative in quarter 2 2020. But then when we project outward for quarter 3 and quarter 4 2021, we can see that real gross output plummets, and it plummets well below that 2% threshold. It actually plummets down to about negative 4%, and I project out that it's going to stay there. If we get another year of bad inflation, much like what we've seen in 2021, then we are likely looking at a recession developing in 2022. Now, I'm going to let the numbers do the talking here and explain the story, but I'll walk you through it. When we take a look at the last previous trends effects that changes in the producer output of the economy had on real GDP, the trend becomes clear. So during the 2008 burst, we had real producer output, just the producer side of the economy, grow at a 2.5% growth rate, and then it contracted by 9.4% at its lowest point during the 2008 burst. Likewise, real GDP was growing at about 2.5%, and then it contracted down to 4% during the bottoming out of the 2008 crash. During 2011, real producer output was growing at a higher rate at 4%. Then it negated and went down and went negative down to a negative 3%. Likewise, real GDP at its peak was growing on an annualized basis at 3.3%, but then it contracted down to just barely a growth rate at 0.9. So it did not throw the economy into full recession, but it was definitely, despite all the fiscal and monetary stimulus trying to keep real GDP afloat, it did not drag it into a full contraction. Had we not had that monetary and fiscal stimulus, and had we had this contraction in real producer output, then yes, we would have gone into recession. However, I preface all that to say it's been the monetary and the fiscal stimulus that is causing this back in 2011, real producer output to go negative because it was increasing producer prices. So when we pull the producer price trends for that time, of 2011, we're going to see that producer prices were spiking at that time, much like they are now. And now it's even worse than what it was during 2011, and that was the major contributing factor to why producer output went negative. So you can see how producer prices were increasing at an annualized rate of 11%, and now they're increasing at an annualized rate of 20%, almost double of what they're having in 2011. So the likelihood that we will suffer a severe contraction, more severe than what we saw in 2011, much closer to what we've seen in 2008, is very, very likely despite the stimulus that's been coming out. During the 2020 COVID pandemic, and this is sort of an unusual event because this was more of a forced crash in the economy, the trends become clear. You had real producer output change from a positive 4.3% to a negative 4.7%. Real GDP changed from 2.5% to a negative 9%. And remember that the severity of the crash was because a lot of the retail and consumer sectors of the economy were shut down more harshly than the producer sides of manufacturing, construction, mining, logging, and all those other goods producing sectors that make up the producer side of the economy. So that kind of explains the disequilibrium that we have and why it breaks the trend of the last two changes in the economy. But what were to happen if we were to go and look at the collapse of what's going on in real producer output in 2021? Well, based off my projections here, we're looking at quarterly changes or an annual change bottoming out, a potential bottoming out of the producer side of our economy. The producer side of changing from 2.5% on the positive end to a negative 8.3%. Does that sound familiar? It should sound familiar because that's very much like what happened with the real producer output numbers just before the '08 burst. The situation is just different. It's not that the '08 burst caused a contraction in real producer output because of bad credit, bad malinvestments coming to light, and losses accumulating. It is sheerly being caused by high prices on the producer front, which is curtailing production on the manufacturing front, which is then going to feed into higher consumer prices on the consumer front, and that will drag the economy into recession. Yet because real GDP was spiking at about 12% year over year on the peak, I don't have our real GDP numbers going negative by the end of this year. Instead, what I'm thinking is that we're probably still going to have a fairly positive real GDP number. Now, what is real GDP? It is GDP taking into account the inflation rate. So inflation is going to be higher, but the higher nominal spending that is going on in our economy will keep the economy technically afloat on the consumer end. It's 2022 that I think that we're going to see a real problem develop in the economy because producer output is going to stay negative. And we haven't seen this happen where it stays negative for longer than 2 quarters, especially at this severity of a contraction since the '08 crash. And that's what I think it's going to happen, is that this higher inflation is going to drag the economy into recession as real producer output maintains its negative status of negative 8 to negative 9%. And that's assuming that producer prices continue to increase at an inflation rate of, say, 10 to 15%, which would be a milder version of what we've seen in 2021, but still severe enough to cause a technical recession. And I think that's what's going to happen as we see real GDP deteriorate from positive to negative, absent of some type of fiscal stimulus to try to keep ahead of the curve. But remember, even if we did get that fiscal stimulus in 2021 or 2022 to try to boost GDP, it will only be a temporary boost, and it will be at the cost of even higher prices down the road, which will then almost ensure that there's a recession. The real risk to all of this is that we could get a double burst in the economy. We get the first crash caused by higher prices, but then we get the second crash because either the higher prices or higher interest rates from higher prices or both cause a crash in the credit markets, which then plunges the economy from outright recession to outright depression. That's the real risk. That's what's going on, is a deflation of the asset bubbles that have developed in the stock market, the bond market, as well as the real estate markets. Now, I think that in terms of real estate and construction, for especially regarding housing, that will probably be the last bubble to burst because of the shortage of inventory on the residential housing markets. But
I do believe that the stock market could easily go into a contraction, if not in quarter 3, quarter 4 of this year, certainly at some time in 2022. As the economy is dragged kicking and screaming into negative territory. And then the Federal Reserve and the government are going to be caught between a rock and a hard place. Do they try to stimulate their way out of the recession and risk higher inflation and higher interest rates, which could then cause an even worse crash? Or do they risk the economy and unemployment building, which then burst the credit bubble, but at the same time it causes prices to stabilize at least, if not correct. But then you get problems where you might go into a banking crisis where you get a credit freeze on the banks, much like what we were seeing in 2008 because of all the losses that were accumulating on the debt markets. That's a real possibility. It's not caused by subprime mortgage loans. It's caused by subprime government fiscal spending. The government has been spending more and more of our money, eroding away at our growth. We're seeing the effects manifest in the inflation markets, and now it threatens to burst that credit bubble. That's the real threat that we're seeing now, and that's what I'm looking at, unless if we start to see the producer prices abate. If we start to see producer prices abate and then consumer prices abate, we might be able to escape this deathly scenario. But right now, based off the trends, I don't see that happening. The M2 numbers came out, the money supply for M2 came out for August, and they returned back to a high growth rate of greater than 1% on the M2. So when we start annualizing the CPI growth, we're still looking at CPI annualized growth year over year of over 4%. Well, remember that my rule of thumb was that producer prices increase threefold to every 1% of the CPI increase. So that's conducive with a producer price inflation of at least 10%, if not up to maybe 15% or somewhere in between at about 12 to 13%. And if we get that inflation rate, of 10 to 15%, or higher on the producer price index, which we might just see, it really does threaten to destroy the economy from the back to the front instead of the front to the back. Instead of seeing the huge deflation in consumer spending, we're going to see the decrease in producer spending that's not fully being captured in the real GDP numbers, especially in the real GDP numbers. And then we will see that in the real GDP in the following years. So that's my outlook that I think is going on right now. And that's the real danger and threat. That means if what I say is true, then the only things to buy is to invest in as a full safe haven will be precious metals in this effect. It is theoretically possible that one could invest in bonds if bond interest rates stayed low. And if so, bonds could become lucrative during this time to hold and preserve as cash. But I do think that equities will take a downward hit and we could see a severe contraction in the stock market. Just right quick, I'm going to pull up my stock market chart right quick and show you just how much I think that the stock market is overvalued right now in comparison to real GDP. And when we take a look and factor in real GDP and subtract out government spending, because governments don't directly invest in the stock market, it looks like the stock market is overinvested by about 3 to 1 on the ratio here. This is just quarter 2 numbers. So if it's really overinvested by 3 to 1, we could see a Dow Jones Industrials contract down to under 15,000 from its 34,000 points right now. It could even contract down to about, say, 10,000 or so. It's very possible that we could see this develop, and this could be extremely dangerous for investors because a lot of the holdings that are tied into equities would basically wipe out their retirements. It would wipe out returns on investments. It could cause severe distortions and ramifications in the markets if we see this severe type of contraction, because it may cause capital to outflow from the U.S. Now, thankfully, one of the things that is a saving grace right now, and I'll probably produce a video talking about this, developing my thoughts later, is that we're seeing energy crisis develop in both China and Europe. And because of that, it may create instabilities in those areas where we may see capital fly out of those regions into the U.S. and shore up here. And where are they going to buy? Well, they'll buy the dollar, they'll buy bonds, and they'll buy equities most likely, and then real estate. And that might mitigate that free flowing of capital and and increasing relatively the supply of resources might mitigate some of these inflation numbers that we see, particularly on the producer front, and help calm that inflation down. If we get that inflation, that producer inflation, to calm down, say below 10% annualized inflation, then we might see us stay above water, and this projection would have turned out to be too negative. Instead of getting, say, a negative 2% contraction, we might get something akin to what we saw in 2011, which is a weakening of real GDP growth, but yet staying positive. Guys, that's all I have for this video. Again, thank you guys for watching this. Make sure you click the like button, subscribe to my channel, click that notification bell. Let me know what you think about all of this. If you have any questions about all of this, or if you have a topic that you want me to cover, whether it's relevant to today or if it provides context of what's going on today or some type of economic analysis, I will be happy to provide that. Just let me know. Again, guys, I thank you for watching this video. I'll be posting more throughout the week, and I'll talk to you next time.